Hey Bowtie Nation, Joseph Hogue here. Thank you for joining us for another one of these Monday market updates, 9 a.m. every Monday morning. Get you ready for the week, what stocks to watch, the economic news to highlight, as well as a topic for the week. This week, a great topic for you. It seems investors are getting pushed and pulled every direction this year, right? The number of up days and down days by more than 1% has surged over the past couple of months, and it's likely to get worse before it gets better. Those huge swings in volatility. The good news is, though, it seems like the market wants to move higher. That investor sentiment is still positive enough. It wants to claw back any losses that we hit. Now, that's going to mean that while some stocks might suffer in a sell-off, then there's others that are going to be rising. And that's what I want to show you how to find today, how to find the stocks for 2023 that have a better chance of going up. To do that, we're going to be using the FactSet Earnings Insight data of great free research available to anyone out there on the web. I'm going to show you how to find that pretty soon. But what they do, they just survey all the analysts out there, their price targets. They survey the companies as far as earnings, kind of put the two together to find out where those corporate earnings, those corporate profits are matching up with analysts' expectations and what those stocks are doing. Now, to find this, all you got to do is go to Google and search in Google this FactSet Earnings Insight. So it's going to be FactSet Earnings Insight. Search that up, and usually one of the first two is going to be the Earnings Insight. It's going to be Earnings Insight there. You just click on that. It's going to open up the most recent edition there, always updated on Friday with the most recent statistics and news for stocks. I highlighted last week some extremely bleak forecasts by analysts that now expect profits for the S&P 500 companies to fall by 8% in the fourth quarter 2022. That's that reporting period being now reported over the next couple of weeks by companies expecting earnings, profits by S&P 500 companies, ex-energy companies, okay, because energy companies are going to be blowing the numbers out of the water with a 60% year-over-year gain in profits. But the rest of the companies in the market, the S&P 500, expected to report an 8% drop in earnings, and that's only going to get just as bad in here in the first and second quarter. You see here I've got the highlighted first quarter analyst estimates are for a decline of 1.1% on revenue growth of 2.7%. And then in second quarter 2023, analysts projecting earnings decline of 1.2%, revenue growth of just 0.3%. So analysts on Wall Street are now saying for the first 6 months of this year, for the first quarter is 3 months, second quarter is another 3 months, they're expecting earnings to decline sequentially for companies in the S&P 500 by 1%, 1.2%, and 1.1% each of those quarters. And since stocks are an ownership of those profits, when you buy a stock, you're buying a share of the company, a share of those future expected profits. When those future expected profits go down, when they're expected to go down, the share price is probably going to go down to adjust for that as well. But as usual is the case, so just looking at that total stock market outlook really hides that what still could be a very good year for individual sectors, individual stocks in the market. For example, analysts are forecasting growth of just 3% in sales for that broader market and about 4% in earnings. That would be anemic. That would really keep the market where it is. But if we look closer here, and here I've got two charts, one of the expected S&P 500 earnings for each sector in this current year, the current 2023. These are the 11 stock sectors of the economy, as well as the stock market itself, the S&P 500 itself there about in the middle, and the expected earnings for each sector. If we scroll down, we've also got the revenue growth. So the sales outlook for each of those 11 stock sectors in the economy for this year. If we scroll down here, we see that 7 of the 11 stock sectors are expected to report faster sales growth, faster than that 2.9% sales growth expected for the entire market, to as high as 8.9% for financial companies. Then back up to earnings, we see 6 sectors are expected to report market-beating growth in profits, as high as 31% for consumer discretionary companies. So what I want to do with this is I want to take these two charts along with some valuation data, some price to earnings data for each stock sector to show you the stock sectors, the stocks in each sector in each part of the economy that are expected to grow faster than the rest of the economy and are cheap on a valuation basis. So which stocks are expected to outperform on those sales and the earnings growth, boost those profits faster than the market, and the ones that are already cheap enough to buy. And if we start here on the far left, the consumer discretionary sector expected to post the second highest revenue growth, about 5.7% in sales growth this year for the stocks in the consumer discretionary sector, and by far the highest earnings growth, 31.6% earnings growth expected for the consumer discretionary sector this year. Now, that said, I do want to scroll down and use this in conjunction with the valuations here to show you, that not only is some of these sectors are going to be growing faster than others, but they're also valuation territory as well. But it might not be the consumer discretionary sector. Okay, what we have here is the the S&P sector level forward 12-month PE ratios, right? So this is that PE ratio, the price of all the stocks in each sector divided by their expected earnings, the earnings expected to be posted by those companies in each sector over the next 12 months. So you get that valuation, that core valuation ratio for companies. How much are investors being required to pay for each dollar in earnings? And here, if we do look on the far left in the consumer discretionary sector, the consumer discretionary sector is the most expensive sector in the economy right now on a price to earnings basis. And that is after falling 38% last year for the stocks in that sector. It is still valued at 22.1 times on that price to earnings basis. That is just slightly below the 22.3 times the long-term average. So it is just a little bit below its long-term average valuation, a little bit cheaper than the long-term valuation, but not necessarily cheap either. This is what I want to do. I want to start with that big picture idea, right? Find the sectors of the economy that are growing faster than the rest of the market, right? Finding the ones that are going to benefit as higher sales growth, higher profits, higher earnings growth really takes off this year versus a market that is going to be posting really disappointing earnings and sales growth. Then I want to look at valuations and find which of those are already cheap on a valuation basis. That's going to give you your best bet for the stocks to buy right now. And we can go into each sector, find what stocks we like within each sector, and really give you a much more rational and certain way to pick stocks rather than just trying to find your favorites out there in the bunch. Here again, looking at the earnings growth chart. So the expected earnings growth for each sector of this year. We go next to the financials. Next in line here, the financials are expected to report 13% earnings growth for this year. And again, these are all compared to the S&P 500 here in the middle, expected to post 4.2% earnings growth for 2023. So financials, stocks in the financial sector, that would be your banks, your insurance companies, your asset managers, all expected to post on average earnings growth, profit growth that is about 3 times more than the overall market. Not only that, if we scroll down to the revenue growth, we see that financial stocks in the financial sector are expected to post the best sales growth, the best revenue growth for the year out of 11 sectors. 8.9% revenue growth for the financial companies versus the S&P 500 average of just 2.9%. So again, almost 3 times more revenue growth for the financial companies than the broader stock market. And of course, we've talked about this on the channel over the last couple of months that the banks especially are coming into an era of profitability that could be just as good as any time since the 80s, right? Anytime those interest rates rise, banks are going to be making more money off those loans, right? And right now, the yield curve is kind of funky because we're worried about going into a recession, so the short-term rates are pretty high and the longer-term rates a little bit lower. But as we move into a little bit more economic growth, probably towards the end of this year, that yield curve is gonna steepen a little bit, and the banks are gonna make money hand over fist. That's really where this earnings and the sales growth and the earnings growth is going to be coming from for the banks. And what we see is not only are the financials expected to post the best sales growth out of all 11 sectors and the second highest earnings growth for the year, we can look at the valuations here and see that it is one of the cheapest sectors on a valuation basis as well. All the way over here, second to the right, financials trading for just 12.4 times on a price to earnings basis. That is versus 13 times on a long-term average. So that's about a 5% discount to its 10-year average. Stocks in the financial sector are trading cheaper by 5% than to that long-term average there at that 12.4 times price to earnings basis. So that's really the perfect setup that we're watching for, right? Any sector that is posting higher than normal or market-beating earnings and sales, but is also cheap on a valuation basis. Another area of potential strength here I want to look at is communication services, about the fourth one over on the right here. Expected post sales of 4.6% sales growth this year, 9.3% earnings growth growth. So again, that about the fourth best sector for earnings growth this year, communication services. It's going to be all your telecom stocks, your gaming stocks, your internet stocks, your social media companies. And of course, we know this was the second hardest hit sector in the economy last year. Next to consumer discretionary, stocks in the communication services sector fell 38%. Okay, again, telecom didn't get hit too hard, but you had all your internet stocks, your gamers, your social media stocks. A lot of these companies run off the ad revenue, the advertising of other companies. And as other companies pulled back on their advertising revenue, fearing a recession, and before they wanted to lay off staff, they cut those ad revenues, and these companies really suffered. Now, what I'm thinking though is while a lot of industries can continue to report very tight labor markets, okay, your services sector all reporting very tight labor markets, hard to find workers, and wage pressures, having to increase those wages. A lot of these social media, the internet companies are laying off large swaths of their workforce. We're seeing that with Google. We're seeing that with Meta. We're seeing that with all the tech companies, Apple. That is going to lower the operational costs and should help boost profitability, which is where we're seeing this, probably going to see this earnings growth come from for the stocks in this sector. And now looking at the valuations here, we see this one is the third cheapest stock sector in the economy, right? Communication services here trading for 15.1 times on a price to earnings basis. That is about another 4 or 5% cheaper than its 15.9 times long-term average. And remember, a lot of the stocks in these companies, a lot of the stocks in this sector are growth companies. They are those growthy social media, internet companies that generally trade for a very high valuation, a higher valuation into the 16, 17 times on a price to earnings basis, not 15.1 times. So stocks in this sector, very cheap after last year's sell-off. But here I also want to look at the other side of the chart, maybe for a little bit of a warning to see which sectors are expected to post declines in earnings and sales for the years, which sectors you might actually need to avoid. Here, if we're looking at the revenue growth expected for 2023, we see two sectors are expected to see total revenue actually fall this year. That's materials here with a 3.6% decline, and energy expected to see revenues fall 8.4% for the year. Now, the companies in both of these sectors benefited from really strong commodities and oil price spikes last year, but might not get some of that tailwind here in 2023. Looking at the earnings expected here, three sectors are expected to see that drop in earnings for the year. Energy here is expected to see a drop of 15%, 14.7% for the year. Materials expected to see their profits drop 11.6% this year. And then even healthcare stocks expected to see earnings drop by 4.3% this year. Here on the valuations, we do see that stocks in the healthcare sector are trading relatively expensively here at 17.2 times on that PE basis. That is well above the 15.9 times long-term average. So stocks in the healthcare sector are trading fairly expensively here, especially a lot of those drug stocks that didn't fall last year as the rest of the market crumbled. So really protected your money last year, but might be time to take some of those profits on it. A very relatively expensive sector here, and earnings and sales growth that just probably isn't expected to go very far in 2023. We also see that materials also trades for just above its 10-year average here, about 16.5 versus that 16.4 long-term average. So fairly expensive there on the materials sector. So in a little bit, I'm going to show you how to find the stocks in those sectors, the stocks in sectors like financials, like communication services that we might want to highlight to buy because of those valuations and the growth expected this year. First, I want to highlight some of the stocks I'm watching this week. About 1 in 5 companies in the S&P 500 will be reporting their earnings this week. So it's going to be a very busy week watching those. And first, I'm watching Tesla, ticker TSLA. It's going to report its earnings on Wednesday with the shares already up 23% from the recent lows, but really good reason to be optimistic into earnings coming up this Wednesday. And all you out there in the nation know I'm usually not a Tesla bull, okay? I've never been able to really buy the shares a bit with the valuations as they are, but I think now is a really good time to pick up shares there, especially in the near term. And while the fourth quarter numbers are expected to show kind of slowing revenue growth compared to what we've seen in the past, is what the company could say about the first quarter that I really think is going to continue that rally in shares of Tesla. Tesla offered significant incentives and price cuts into the new year, and reports are very strong orders that in orders in China and globally over the last few weeks on those price cuts have just jumped on those lower prices. Now, never one to pass up a chance to promise the moon. I think Elon Musk is going to take that opportunity to give investors what they want to hear when he gives that 2023 outlook here on Wednesday. I think that keeps this current rally in the price going. I think you make some good money here in Tesla over the next couple of weeks. Unfortunately, I do have to warn you. I think after this current rally fizzles out, maybe later in the quarter, I think we find that a lot of those price cuts, a lot of the incentives offered last year, a lot of the price cuts this year just brought forward orders. They brought forward orders that would have happened in the rest of the year. And that means as we get into the second quarter, as we get into the third quarter and fourth quarter, and finally and really see the orders that happen in the rest of the year, I think those are going to disappoint. And I think that you've got a big chance of some of that rally fizzling out and giving back some of those gains. Shares of 3M, that's ticker MMM, is down nearly 10% at one point last week as inflation and a strong dollar really threatened to make this Tuesday's earnings report a bad one. The company is expected to post slightly positive earnings growth, about a 6.7% drop in revenue for the quarter, but slightly positive earnings on that. The bad news is likely baked into the stock at this point. I think the shares are trading for about 10 times on the price to earnings basis ahead of the planned spinoff this year. So shares of, it is expected to spin off its healthcare segment into a new company. Shareholders, investors in 3M will get shares of that new company as it spins off later this year. Now, we do know that shares of General Electric are already up 18% this year, leading up to and through the first of its planned spinoff. We've talked about this strategy before, buying these companies before they spin off these new companies, and it could happen to 3M later. So I would be buying 3M here towards the end of the year, ahead of the spinoff, to get shares of both of those stocks. Chevron, ticker CVX, actually one of my favorite oil and gas companies, going to report its earnings on Friday, but could be a rude awakening for energy investors that have just been spoiled over the last year's bumper cash flows. Now, to be sure, at $80 a barrel oil, energy companies are still operating at high free cash flow and will be able to support those dividends, but it's going to be two very rough quarters for comparables coming. Okay, if you remember back last year in the first and second quarter, that spike in oil spiked in February of last year on the Ukraine invasion and then rose steadily to $120 a barrel by June. So from February all the way through mid-year last year, oil prices were rising very quickly, and that meant huge cash flows for oil companies, right? Oil companies that just didn't know what to do with their cash. They're buying back billions of dollars in shares, increasing their dividends hand over fist. It also means that without another spike in oil prices, though, this year's cash flow during those first two quarters is going to look weak by comparison. Management is likely going to point that out, going to point out the need to be a little bit more conservative in its dividend growth and the use of cash, and I think it's something that could spook investors. Here I want to look at what stocks in each sector did last week, and this is where I'll show you some of the stocks in those sectors that we want to highlight for 2023 are. Again, of course, we're on the sectorspider.com, the sector tracker. Great free resource for you there, sector tracker. It's going to show you what stocks in each sector did over different periods. Going to show you the stocks in those sectors. We can see that 3 of the 11 stock sectors closed higher last week, with really a continuation of the rebound theme playing out from that last year's hardest hit sectors. Okay, we saw some of the hardest hit sectors like communication services, like technology, rising last week as a lot of the other sectors sold off. In fact, if we zoom out year to date, we can already see the communication services sector up 10.6%, consumer discretionary up 7.6%. So those hardest hit sectors really taking it off on the rebound play this year. And if we click on any of these sectors, we can see which stocks are in those sector groups. We can see here communication services. Again, you're going to have your telecom names like your AT&T, your Verizon. You're going to get your streaming companies, your media companies like Netflix, Chartered Communication, Walt Disney, Warner Brothers. And then you're going to get your social media platforms like Meta platforms, like Twitter, like Pinterest. Here, that other sector we wanted to highlight was financials. So here in the financials, we're going to see you've got all your banks, your insurance companies, your asset managers, your data research firms like S&P Global, MSCI. You're going to have your credit card companies like Discover Financial. Now, one thing I do want to point out when we're looking at these sectors, those safety sectors really offered no shelter last week, with stocks in consumer staples and utilities really underperforming nearly all the others. Here we're back on the 5-day performance. We can see that consumer staples down 2.8%, utilities down 2.9%. So both of those very widely underperforming the market. If we go back to our revenue and earnings outlook for the year in these sectors, it is not great either. And the fact that many of these stocks didn't fall as much last year means that valuations are going to be stretched as well. So for example, the consumer staples sector expected to post revenue growth. So stocks in the consumer staples, that's going to be all your personal care products, your food packaging, the things that people need to buy even in a recession. So they tend to hold up when the stock market crumbles, but expected to post revenue growth, sales growth of just 3.6% and earnings growth of just 4.3% this year. So very much subpar earnings and sales growth next year for utilities. Also expected to post about 6.2% earnings growth, so a little bit better earnings growth there for utilities. If we look at valuations for these companies, again, since these stocks didn't sell off with the rest of the market last year, they are still very high, very expensive on a PE basis. For almost non-existent growth, investors are expected to pay a price of 20.1 times for stocks in that consumer staples sector. That is the third most expensive sector. You see here, stocks in the consumer staples sector selling for 20.1 times on a PE basis. That is well over the 19.2 times, so not cheap on a historical basis, and for really no earnings or sales growth. For their part, utility companies, the fourth most expensive sector of the 11 stock sectors, trading for 18.3 times on that PE basis, despite its revenue that's only expected 2.7% higher this year. Want your dividends every single month? Click on the video to the right for a ranking of the 61 monthly dividend funds. Every monthly dividend fund ranked by return, by highest dividend yield, all to put money in your pocket every single month. Don't forget to join the Let's Talk Money community by tapping that subscribe button and clicking the bell notification.